the last 2 weeks or so have been very eventful. Crude prices went over USD 67 a barrel, US yields spiked to 1.60 plus, break-even inflation expectations are highest since great financial crisis. Emerging market currencies, especially the INR, saw a 2% depreciation in a single day. Gold collapsed to below $1,700 an ounce, and equity showed some transient nervousness as well. This concoction makes now a very interesting time to study the intermarket linkages. Hello and welcome to the 8th episode of the Calm Allocators. We are grateful for the viewership the previous episodes have gotten, and we continue to hope that coming episodes will help in ironing out the market noises. And speaking of the noises, the last 2 weeks or so have been very eventful. Crude prices went over USD 67 a barrel, US yields spiked to 1.60 plus, break-even inflation expectations are highest since great financial crisis. Emerging market currencies, especially the INR, saw a 2% depreciation in a single day. Gold collapsed to below $1,700 an ounce, and equity showed some transient nervousness as well. This concoction makes now a very interesting time to study the intermarket linkages, and we are privileged to host none other than Mr. J.C. Perez, a name that needs no introduction for his expertise in this field. He is a chartered market technician, founder of All Star Charts. You can see his work on Bloomberg, CNBC, Fox Business News, and host of other media outlets. He has been a speaker at key investing conferences and often goes to some top universities in the world, Harvard, Duke, Chicago alike. JC has also been a frequent visitor to India now, having spoken at multiple conferences, and he, as he says, loves Indian food by now. JC specializes in finding the most opportunistic risk-reward trade, and at the same time uses the top-down approach while finding the opportunities in the market. Welcome again, Jesse. It's a pleasure having you.
Happy to be here, Ankia.
Okay, now let me pick one asset class for you to begin with. We spoke sometime back in August 2020 when you mentioned a commodity bubble is in the making. Fast forward to today, some of it has already played out and most commodity indices are probably a notch above their 2019 levels. What's your call now? Is this beginning of a structural commodity reflation, or are there many short but fast cycles ahead?
Yeah, I think that this is still early in the stages of a commodity super cycle. In terms of a commodity bubble, I think we're ways away from that. I still think we have a long way to go. When you think about the types of stocks that have been doing well around the world, you know, we are now in the second year of a bull market, and not just in the United States, not just in India, but globally all over the world. You know, India and the United States have both reaped the benefits and have been two of the strongest countries in the world. If I'm not mistaken, US might be one, India might be two, depending on what time frame you're looking at. But let's remember that that has not been the case around the rest of the world. Look at Latin America, look at a lot of these, and even in the developed markets like Canada and Australia, and all of these countries that have so much exposure to natural resources, which is not the case in America and not the case in India, but in the case in a lot of these other countries that have struggled. So now what are we seeing? The leadership groups are these areas. And not to mention, it's not just commodities, it's financials too. So what you're finding is you're finding a lot of these countries where, like Canada, for example, is 70% financials and natural resources and some industrials, 70%. The United States is less than 20% between all of those, right? And India. So you're seeing these countries that have this exposure. So the effects of the commodity supercycle are not just seen in commodities. You're seeing it in the countries that they're taking these commodities out of the ground, right? As they say, the companies that build the machines to take those commodities out of the ground, the commodities themselves, right? So it's a major reflation trade. And when you combine the strength in energy with the strength in financials, it's a completely different landscape than an environment that is being led by technology stocks and growth stocks. It's just a different environment. And I think a lot of investors are having a tough time wrapping their heads around, oh, it's not just solar and tech. Now I have to buy old, dirty energy companies and these bank stocks that I hate so much that my parents lost all their money on, right? Like, it's hard for investors to conceptualize that we're in a new environment. We're creatures of habit as humans, and it's very difficult for us to acknowledge that things have changed and we have to move on. For us, that's great because we have been early in that transition, and the longer it takes people, the more money we'll probably make.
Sure. So taken on the commodity front, and we also spoke on gold. Now you said it remains, it's positive and one should go on to buy it. Has there been any change in base metals versus gold as we speak today?
Yeah, so gold hit our upside targets last August, right? So, which were the former highs from 2011, right? And gold priced in USD, right? So it finally got back to those former highs after almost 10 years of nothing. We're back there. So that was our target. We got there. And then we have been in the camp that gold eventually does break out and goes on to make new all-time highs and starts a new cyclical bull market or even a structural bull market. The problem is that once we hit those former highs, we didn't know how long it was going to take for gold to consolidate, digest those gains, and then eventually move forward. Maybe it took a few weeks. Maybe it took a few months. Here we are on 6 months, and we're still making new lows. So our patience in gold has paid off beautifully. Something else I'd like to add is that gold has done as poorly as gold has done. It's done that in an environment that we have a weaker USD. So just think about how bad gold is. It can't even go up when the dollar's getting destroyed, which is very, very interesting. So just imagine if we get a dollar rally, what's that going to do to gold? So there are some well-defined risk levels here in gold and in gold mining stocks in the United States that we're buying here. What I would encourage everyone to look at, it's very simple. If you look at an exchange-traded fund in America, the ticker symbol is GDX, and that is an exchange-traded fund that covers all of the gold miners, or the biggest gold miners, I should say, in the United States. $31 per share. That had been resistance since 2013. Every time it got to 31, it sold off. 31, sold off. 31, sold off. Last year, we were able to get back above that, and we broke out. And then we have now pulled back to that 31. So if you're an investor in gold, no matter what country you live in, no matter what you're doing, if you're an investor in gold and you are not watching this chart, I think you are you're missing out on a beautiful opportunity to help yourself manage risk and give yourself put yourself in a position where risk is well defined and the upside, if you're right, is exponentially greater. Because if gold is ever going to start rallying, this would be a perfectly logical place to do it. Now, the market doesn't care what JC thinks is logical, right? So let's remember, 31 is the level. If GDX is not above 31, we cannot own gold. Cannot. Above 31, I like it.
Sure. And then that brings me to dollar index that you said. Dollar has been weakening, and then last 3 days we've seen some blip. I think it's trading at 92 levels today. Your take, could it surprise in the upside after months of weakening now?
Well, what's really interesting about the dollar is how tightly correlated it is with risk. So if you recall, the US dollar peaked in the fourth quarter of 2016 when stocks started ripping higher. Then the dollar bottomed in January of 2018 and started to rally when stocks all over the world peaked and started to fall. Then the dollar bottomed in March of last year. Or excuse me, the dollar peaked in March of last year when the stock market bottomed. So I would argue that a weaker dollar is good for stocks. A stronger dollar is probably going to put some pressure on stocks, particularly emerging markets. And you've seen that over the last couple of weeks or the last week or so. You've seen a little bit of strength in the dollar. And what happened to emerging markets, right? They took a little bit of a pause within this bigger trend. So I think if you're bullish stocks, any kind of stocks really, anywhere in the world, I think you're looking for a weaker dollar. Even a muted dollar, it doesn't necessarily have to go down. It just can't go up. It just kind of, if it hangs around, goes sideways and dribbles, that'd be perfect. So what I would look at is 1.2 on the Euro USD, because the Euro represents 60% of the dollar index. And also the Euro has a lot of exposure to emerging markets. So you're going to get a lot of information from that currency. So 1.2. If we are above 1.2 in Euro USD, the bet is weaker dollar, higher stocks.
Sure, taking that there. And as you linked it to the EM markets, and now last we spoke, we talked about the breakout in the small cap index in Nifty in India. I think back then we were at 10,000 and 15,000 sounded like firecrackers everywhere. But here we are, we've gotten at those levels. Now, two questions as far as general EM scenario is concerned and Indian specific is concerned. Do you think that we could get more breadth in the markets compared to where we are? And are there any signs of excesses that have developed, or we continue to be in a structural up move?
Yeah, can we see better breadth? It's a good question, because this is some of the best breadth we've ever seen, ever. So it's hard to get better breadth than this. The market keeps finding a way. We got the most amount of new highs ever, like last week. So, and I've said this before in recent months, and we keep getting new records. So when I say, can breadth get any better? Like, in theory, of course it can get better, but just the point is breadth is strong. For weakness, we are looking for an absence of new highs, when in fact we are seeing expansions in new highs. So more stocks are making new highs than ever. More countries are breaking out to new highs. More sectors around the world. I mean, think about this. The worst places in the world have been banks and energy stocks. Who are the leaders now? Banks and energy stocks. That is sector rotation. That is breadth expansion. And as one of my mentors, Ayush knows him, Rafa Kampora, as he said, JC, sector rotation is the lifeblood of a bull market. When you go back and you study old bull markets, what happens? You have some stocks and sectors that are leading, and therefore some countries that are leading. And then those start to not weaken, but weaken relative to their others, right? So just because they're not leading doesn't mean they're not going higher. It just means that another group has taken over that leadership role. It happens in every bull market forever, and we've gotten that now as now financials and energy and natural resources and countries and sectors that have not participated, like India and the US did, are now participating. And that's breadth expansion. And we keep seeing that. So until that changes, we need to be in the camp that this is a structural bull market, and we want to take any opportunities of weakness in stocks to buy more of them.
Sure. And as much as you study global markets, you study Indian markets as well. So what targets on Nifty, mid-cap and small-cap indices, and which sectors and which stocks are you watching currently?
Well, the former highs in mid-caps and small-caps have been the target. Mid-caps got there. Small-caps are still to get there. Banks and energy. It's not just an India thing. It's a global thing. ICICI Bank, 723, Bajaj Finance up to 69.10, I think it goes. Aegis Logistics with a target of 420. Kajaria Ceramics could get up to 1,200. I mean, there's a lot of interesting opportunities, again, in India and around the world as we continue to get the sector rotation. You mentioned small caps. One thing I'd like to add is when you go back and you study how the market has reacted when stocks are doing well, you see Indian small caps outperforming large caps. That is strong evidence of risk appetite for stocks. So if small caps, it's not a coincidence that small caps started to underperform in January of 2018 when stocks all over the world started to fall. And it's also not a coincidence that small caps started to outperform last year when the stock market bottomed and have been outperforming this entire time. That's not a coincidence, right? We see that over time. So what you want to watch is study those intermarket relationships and keep that relationship handy. And every week, go look, be like, oh, are small caps still outperforming? Oh, I should probably be buying stocks. A week later, oh, small caps are outperforming. I should probably be buying stocks. When you start to see small caps underperforming, That is the signal, but that hasn't happened yet.
So you continue to be bullish on index level as well. Any specific targets for Nifty per se, given that small caps will continue to outperform?
Yeah, here I'm pulling it up as we speak. Here, let me just guess so I don't want to give you the wrong levels, but 20,000 on Nifty. You know, I don't see any reason why we can't get there, right? I'm terrible with the denominator, so excuse me. I mean, when you look at as many charts as I do, I could draw them for you, but then when it comes to the y-axis, it's hard for me to be like, you know, this level, that level, because for me, it's percentage changes is more what I'm interested in, not the exact level, but yeah, 20,000. You know, why not?
Okay, so that's why we've spoken of commodity upcycle continuing, weaker dollar, EMs continuing to outperform, and breadth to continue. Now, what was, I think, the biggest headline last 2 weeks was the US Treasuries. And there's a whole argument that this time around the yields have gone up because better growth is coming in. It's not the Fed. And this time around is different. But at the same time, I think the earnings yield and dividend yield is kind of flattening out now. So your take on this whole yields situation that has panned out, do you think yields would continue to go up and equities at the same time would continue to perform? I think that was probably how it panned out in 2003 cycle. Or do you think it's different this time and there are different indicators at play?
No, I think higher interest rates is good for stocks. And here's why. For a lot of the reasons that we were just describing before, that sector rotation into financials and energy. So why are interest rates going up? Well, the bond market is pricing in higher inflationary forces. As you mentioned, so is the commodity market, as copper's making new highs, oil is making new highs, all these base metals, zinc, iron ore, aluminum, they all look good. You're seeing it in the energy prices as well. You're seeing it in the agricultural commodities also. You're seeing everywhere but gold, right? So you're seeing the commodity market pricing in higher inflation. At the same time, you're seeing the bond market, when you look at inflation-protected treasury bonds and compare those to traditional non-inflation protected, the TIPS, as they're called, are outperforming. So that's the bond market pricing in higher inflation as well. So the interest rate market is obviously showing that. So how does that translate into the stock market? Well, with oil and all these commodities doing well, what's happening in the stock market? Well, the energy stocks are going up. The commodities, natural resource stocks are going up. The countries that have exposure to that area are also going up. So that's the stock market showing, you know, those inflationary forces. In addition to that, as interest rates are going up, that's good for financials. And a lot of these countries around the world have huge financials exposure, India as well. So you're seeing those financials doing very well as interest rates going up. So you have kind of like that double whammy. So when you think of that of energy and financials, what does that translate into? Those are value stocks. And what are the ones selling off? The growth stocks, the NASDAQ, technology were the ones selling off. So value outperforming growth, again, is perfectly normal for an environment that interest rates are going up. Because when interest rates are going down, money flows into the growth stocks, as we have seen. But when interest rates are going up, traditionally, that's good for value stocks, financials and energy, natural resources. And what are we seeing? So the intermarket landscape is doing a beautiful dance. So we're fortunate to be able to be participants in something so magical.
Perfect. So interest rates going up, and as you said, value will continue to outperform growth for some time now. And let me pick you back on the tips front. So usually when there is a commodity reflation, EM currencies, which happen to be commodity importing countries, and specifically USD INR, tend to depreciate. Now, what's your outlook there, since it interests a lot of our investors? So there was one single day when, you know, USD INR had a 2% depreciation in the day. We touched 73.80 levels. What's the general outlook on EM currencies and specifically on the INR front?
Yeah, you know, the way I see it, emerging market currencies and the countries, the stock markets themselves have a much higher correlation than in other currencies, right? So I think you're going to need, I think that's not you know, you have wants and you have needs, right? I think this is a need. I think if emerging markets are going to continue to outperform as they have since last year, if emerging markets are really coming out of this long-term bear market, I think you're going to need the weaker USD. I don't think that's a want. I think that's a need. And if that doesn't happen, I think emerging markets are going to have a tough time. So if you reverse engineer that to answer your question, my bet is the dollar's going to roll over. We haven't seen that yet. If we start to take out those, the 2018 lows, if those start to break on the dollar index, I think that's very, very bullish for emerging market stocks and emerging market currencies. So that's what we're watching. New lows on the Dixie.
Okay, sure. So you expect the EM currencies to appreciate rather than depreciate from here on?
If the stock market is going to go higher, then yes. We haven't seen that
Mind
yet.
the central banks, but taken.
Yeah, I mean, listen, a lot of that information is already priced in, right?
Yes.
If we're talking about it on a Zoom, then it's probably not a secret.
Yeah. I mean, probably the central banks wants to keep their currency depreciated, and they're gonna bulk up on the FX reserves as it looks like. But taken on your idea on why it should fundamentally appreciate from here on if we continue to see the dollar to weaken and EM flows to be positive. Now, JC, since it's a smaller show, I could ask you many more questions, but there's one thing that stood by me when you said that India and US have had their fair share. Which is the market that would outperform this year? One market across the world that you're closely watching for maximum returns this year?
Chile.
Why so?
Well, it's the largest producer of copper in the world. So if emerging markets are going to do well, if commodities are going to do well, you want to go to the countries where they're taking the stuff out of the ground, and Chile is that. If that trade is going to work, Chile is going to work. And if you overlay a chart of Chile and you overlay it with the price of copper, if you overlay it with the price of Freeport-McMoRan, they all look the same. So if that trade is going to work, if copper is going to break out of this 15-year base, Chile is going to do well.
That's an interesting one. And there's also a very novel approach. Even I'm tired of hearing a lot of Europe, China, all of those regular names. So I will start tracking that from now on, JC. Okay, one last question I think would probably be on your outlook on growth in crude. What do you think the fuss is about? Is it justified?
Based on what we're seeing in the bond market, and remember, the bond market is very smart. Based on what we're seeing in the bond market and the stock market all over the world, I think the bet is that people are not expecting oil back to 150 or even 200. The world is not ready for that. People's portfolios are not positioned for that. If you look at the energy weightings in the US stock market indexes, it might as well be zero. It's the 0 weighting in the NASDAQ 100. It's a 2% weighting in the S&P 500. It's like a 1% weighting in the mid caps. Like there's no, American investors have no exposure to energy. And I think that's a problem for them. I think that's a good thing for us because we recognize that. So you're essentially getting a squeeze. You're getting a squeeze of a lack of energy exposure. And if you're looking at oil at 150 or 200, I think a lot of investors are going to be in a lot of trouble. I think that'll be good for us. But I think that the risk in oil is much higher.
Okay. So JC, I'll leave it to you. How would you we've discussed all of the asset classes. So if you were to create a picture of world ahead for next 6 months, what is it?
I think stocks are higher. I think rates are higher. I think oil's higher. I think nifty small caps are outperforming nifty large caps. I think volatility is lower. I think value continues to outperform growth. I think bank stocks all over the world are doing very well. I think energy stocks are doing very well. And I'll leave it with this. The US 10-year at 1.4. If the US 10-year yield is above 1.4, all of the things that I said are probably correct. If the US 10-year yield falls below 1.4 and holds below that, then we need to reevaluate that whole thesis. It's probably wrong. So that's the caveat.
Sure. Very interesting, very insightful, brings together everything on the intermarket front. And of course, Chile is our country to watch out for. So that's my personal takeaway from this one. So I'm going to put that on my list. Thank you so much for joining in, JC. It's a short, but it's a very insightful chat for us. And I hope our clients will benefit from listening to you once again. Thank you. Thank you.
I hope so too.